Hello traders! In this video, we will learn everything about Japanese candlesticks as they are the building blocks for a lot of technical analysis. As you already know from the previous video, technical analysis study historical patterns and behaviors of a given underlying asset. Traders that are using technical analysis look at these historical patterns and behaviors and base their decision upon them. But if you open a new chart in your trading platform, there are no lines or indicators. The only thing you will see are Japanese candlesticks. Japanese candlesticks belong to the most popular method of technical analysis. Searching for specific candlestick patterns was first used in the 16th century in Japan at the rice exchange. These were the very first beginnings of technical trading. As you can see in the image, this is the anatomy of the candlestick. If the candlestick closes above the price where it opened, we call it a bullish candlestick. If it closes below the price where it opened, it is called a bearish candlestick. The green or red colored area is called the body, and the lines above and below bodies are called the wicks. Wicks represent the highest and lowest point where the market traded. Japanese candlesticks are universal. You can use them on any time frame you want. It doesn't matter if you are using them on 1 minute or 1 month chart. So what are the benefits of using candlestick patterns while trading? Among the greatest advantages of candlestick patterns are their simplicity and informational value. After a brief familiarization, the trader can quickly analyze market development and determine what is happening in the market. Are buyers stronger than sellers or vice versa? Can we expect the trend to cease or, on the contrary, could gain in this trend again? In fact, candlestick patterns can reveal the psychology of traders. Various candlesticks shapes can suggest who is stronger, whether it is a buyer or seller. Big green or red candlesticks with a very small wick can oftentimes signal clean dominance of buyers or sellers. On the other hand, candlesticks that have a long wick shows us that buyers or sellers try to push prices, but were not able to push it their desired direction as they got overcome by the opposite side. There are literally hundreds, maybe thousands candlestick patterns in existence, and honestly, you don't need them to learn them all. The most important thing about using candlestick pattern is to put them into the context of what the market is doing and where it is heading, using levels of support and resistance or other technical and fundamental indicators. Also, looking at the candlestick patterns at higher time frames such as H4, daily or weekly, will play much more significance compared to 1 minute or 5 minute time frame. This is simply because those higher time frames attract much more market participants. In this video, we are going to show you the most important ones that you should know in your trading. Long day candlestick pattern. Let's start with the easiest one. Long day, bullish and bearish candlestick. Long day candlestick consists of just one candle with a long body and short wicks. The candlestick usually shows strength or weaknesses, and it can be used as a breakout candle at the beginning of a trend. Most traders don't use long day candlestick as entry or exit signals, but more as confluence with their ideas. Short day candlestick pattern. The short day candlestick is an easy to spot pattern. It consists of one candlestick. Short day candlestick is defined by its length. How short the candlestick must be? This is not 100% defined, so you should always use your discretion and review past trading periods to have a comparison. Short day candlestick is not usually used as an entry or exit signal. Short day candlestick pattern signals the fact that the price stayed in the range during a trading period, and we can expect an expansion soon. They can be found in larger patterns, providing relevance. You should always wait to spot it in a large context and think about what buyers or sellers are trying to achieve in current market conditions. Marubozu candlestick pattern. A very simple and powerful candlestick pattern is called Marubozu. Spotting Marubozu candlestick is one of the easiest things you can do. It signals with a real long body without upper or lower wick. Bullish Marubozu candlesticks show us one pretty obvious thing: the buyers stepping in the market. Opposite of that is that bearish Marubozu that show us sellers stepping in. There are two situations where you can make a trading decision with candlestick Marubozu. If you spot bullish Marubozu in an uptrend or bearish one in a downtrend, trend continuation is likely. If a bullish Marubozu occurs in the downtrend or bearish in an uptrend, reversal is likely to happen. The smart thing to do after you see a Marubozu candle is to wait for further confirmation in terms of other candlestick pattern, support and resistance, or indicators. Closing Marubozu candlestick pattern. In the bullish case, there is only one small difference from a bullish Marubozu, and that is a lower wick. This candlestick suggests that we had some sellers trying to step in after the candle opened, but buyers were much stronger and closed higher. If bullish closing Marubozu appears in an uptrend, it gives a signal of continuation. Another great location of bullish closing Marubozu is a key support area where we can expect the price to rise higher. Bearish closing Marubozu is a bearish candlestick pattern that signal with a small upper wick and a big bearish body. There are two locations where you should be watching for bearish closing Marubozu. In a downtrend, this signals that trend is likely to continue, and at the key resistance level where we can expect a new move down to begin. Opening Marubozu candlestick pattern. Last Marubozu candlestick we will cover is the opening type Marubozu. Bullish opening Marubozu has a small upside wick. It gives us bullish signals in the market. It shows us the fact that buyers took control straight from the open, and even though they met some seller at the top, the bullish bias prevails. Bearish opening Marubozu signals strong conviction from the sellers in the market. Although there is a small lower wick, you can notice a price rally right after the candle opens. Bearish opening Marubozu in a downtrend signals continuation. In an uptrend, it can signal a possible trend reversal. To sum a Marubozu candle up, they are big either bullish or bearish candlestick overall. They give a clean signal that buyers or sellers are stepping in. The spinning top candlestick pattern is a neutral candlestick. By neutral, we mean the fact that it doesn't matter that much if the candlestick closes bullish or bearish. The important factor is the candlestick closing location. The spinning top candlestick pattern is a neutral candlestick. By neutral, we mean the fact that it doesn't matter that much if the candlestick closes bullish or bearish. The important factor is the candlestick closing location. The spinning top candlestick pattern has a single candle with a small body and a long wick. It signals indecision in the market. The general rule of the thumb is that if we see the spinning top candlestick at resistance level, it is a short reversal signal. Vice versa, spotting the spinning top candlestick at support area signals long reversal. The doji candlestick pattern. Similar to the spinning top candlestick, doji is an indecision candlestick pattern. You can recognize a doji candle by a very small body and short wicks on the both sides. A doji is often found at tops and bottoms of trends, so it is considered as a sign of possible reversal of the movement. That being said, more complex doji patterns can be also used in trend continuation. Although doji is an indecision candlestick pattern, there are three different variations which are going to help us make more educated trading decisions. There are long ledge doji, gravestone doji, and dragonfly doji. A long leg doji is very similar to the spinning top candlestick. Compared to regular doji, it is much more dramatic candle with long upper and lower wicks. Long leg doji is the same as the spinning top candlestick. It signals indecision in the market and a possible reversal in the play. Gravestone doji is a bearish candlestick pattern. It shows us a fact that buyers try to step in, but sellers strongly overcame them and push the price back to open. In an uptrend, gravestone doji gives us an indication that the market is ready to turn around. In a downtrend, we can use gravestone doji as our continuation signal. Dragonfly doji is a bullish candlestick pattern. It shows us a fact that sellers try to step in, but buyers strongly overcame them and pushed the price back to open. In a downtrend, Dragonfly doji gives us an indication that the market is ready to turn around. In an uptrend, we can use Dragonfly doji as our continuation signal. The engulfing is the two candlestick pattern. Bullish engulfing forms with a small red candle on the left and big green candle on the right. The big green candle on the right has to completely overlap the candle on the left. The rule is, bullish engulfing candle has to trade below the low of the previous candle and has to close above the highest point. Bearish engulfing forms with a small green candle on the left and big red candle on the right. The big red candle on the right has to completely overlap the candle on the left. The rule is, Bearish engulfing candle has to trade above the high of the previous candle and has to close below the lowest point. Inside bar pattern. The last candlestick pattern is the inside bar candlestick pattern. If you compare it to the engulfing pattern, it is also two candlestick patterns, but the candlestick on the right side is the actual opposite of engulfing. It is a small candle that is completely inside the previous bar. Inside bar pattern by itself is a neutral pattern. It means that it does not give us the signal right away. But highs and lows of the inside bar play a significant role. Once they are broken, we can trade in continuation to the upside or downside. What is also worth to mention is that when prices tries to break high or low of inside bar and fails, we can enter the position targeting the opposite side of the inside bar. Alright traders, I hope you have enjoyed this video, and if you have any question or you are just interested in something or just struggling in something, just let your comment down below. Please don't forget to subscribe our YouTube channel, and I wish you steady study and see you next time.